Right. So that was processing of the customer order stage that we just concluded in video A of our lecture 6. So now we are proceeding with video B in our 6th lecture. And all right, so obviously, like as I was explaining to you, the flow of documents is important because that's where you'll be able to pick up weaknesses. So sometimes it could be to do with the record keeping processes, right? So now, guys, there are things that can take place in the ordering while you're processing customer orders, right? Those things, we call them risks, obviously. And when I'm saying those things, I'm referring to things that could potentially go wrong in the process. So number one, a customer order may not be processed at all. So a customer fills in their customer order form online, send it through to the sales department of the relevant company, and the relevant company does not process the customer order of a company, of a client. That's a risk. So those things, they do happen in real life, by the way. And or that maybe the order is processed partly but never completed. So in other words, processing of incomplete orders may never be followed up and attended to promptly. Fictitious orders could be processed, whereby a customer would fill in the order form and provide fictitious details, non-existing details, right? So that they can be able to scam the company, or there could be unauthorized customer orders being processed, stuff like that. So these are things that could potentially go wrong. I'm not saying it's a comprehensive list, but these are highly probable risks that could take place. But what I'm thinking to do, guys, because I really wanted you guys to understand, first of all, the stages before we talk about risks and all of that. So can I do it as a 2-lecture session? So maybe on Saturday, we can try to cover about the risks and all of that, so that I can make you guys to understand first the blueprint before you can be able to identify where the problem can take place. So let me try to help you understand the blueprint first. So let's go to the second stage. So the second stage in revenue and receipt cycle has to do with granting of credit to the customers. Now, the moment you hear granting of credit, it means that this stage, it's mostly involving the credit division of the company. Now, blueprint description about this is that the sales department should be separate from the credit department. So in other words, there has to be isolation of responsibilities between the two departments. So the credit department has to be on their own side, separate from the from the sales department. So sometimes in the scenarios they can describe is case whereby the sales department and the credit department, they are in one roof doing the same things. So the moment you see something like that, to me, that's a weakness. Why? Because the blueprint tells me the credit division has to be separated from sales department. So anyways, in summary, granting of credit will involve credit controller, credit manager, obviously, as well. And then obviously, this is the duty and responsibility of what we call a credit control division of an organization. So they deal with authorizing credit to suitable or credit-worthy customers. So obviously, in that process, we also see the following documents being used. And we see the use of customer order forms, right, which have been initiated here at the ordering stage by the sales department. So there's a copy that is sent to these guys as well. And the reason why that copy has to be sent to these guys so that they can do the authorization process, all right? So there's a customer order form copy, there's proof of income of a customer, bank statements, customers. So all of these are like background information of a customer that helps the credit department to evaluate the credit worthiness of a customer and get to that point where they can be able to conclude whether a customer can be granted credit or not. So now let's go into your blueprint. I've given you the summary, yes, but let's look at the blueprint so that you guys can gain insight. Some of these things you're already familiar with them. So obviously, according to the blueprint, they are telling you that a credit controller from where? from the credit department will be assigned with the responsibility of credit control of the organization. And now I want you to also notice that the whole purpose of having this department, it is so as for them to help in mitigating credit losses, all right? To help to mitigate the risk of credit losses. Credit losses from where? From granting credit to customers who cannot pay. So their purpose, these guys, is to ensure that they mitigate, they minimize, or they control the risk of credit losses for the company, right? Why is it important for companies to manage their credit? I mean, something to do with their credit, because with credit losses, all right, especially if they are significant figures, they can affect the company's cash flow. The moment it affects the company's cash flow, that implies the revenue of the organization will also be affected. How? There'll be financial losses. Financial losses reduces revenue, obviously. So, yeah. And then, of course, we also get to see that in the process of evaluating the credit worthiness of a customer, the credit controller ought to make use of, I mean, they have to follow the law in that respect. And that's the purpose of the National Credit Act 34 of 2005. So in the process of, for instance, looking for background information about a customer and all of that, in the credit bureau, all of that is so as for the credit controller to establish whether a customer is credit worthy before credit is granted to the customer, right? So that's the whole purpose of them following the National Credit Act and, of course, performing background checks on the customer before they actually authorize a credit to the customer, right? Now, credit worthiness, it's not limited to the existing customers, I mean, to new customers only, but it's also performed on the current customers as well. Now, let me explain how this happened. So with a new customer, essentially, you just want to, look into whether they've got the ability to pay the company for the goods sold to them on credit. And that's where we go through the credit bureau just to see, the credit history of that particular prospective customer. Now, what about the one that is an existing customer? An existing customer, normally, the evaluation around them is done, especially if there's a request for them to increase their credit limit. So if a customer wants to increase their credit limit, we don't just automatically approve of it as the credit division, all right? We also need to consider the ability of that customer to pay at that particular level. Are we together, guys? It's one of the standardized things that need to take place before we can consider giving any additional credit. Notice they're saying an existing debtor's credit limit, payment history, and outstanding balance are considered. What is happening there? It's again a credit evaluation that is taking place before you can even increase a credit limit to a customer. And the person responsible for authorizing all of this, as much as you would have a credit controller, you need to have the credit manager, who ensures that no credit is granted to existing debtors with long outstanding or overdue balances. Right. Now, the credit bureau obviously is just showing you where the information is collected by these guys so that they can do that evaluation. So there's what we call the credit bureau. Most of you are familiar with that, right? And that evaluation, they get it easily online. And that's why, for instance, when you want to apply for a loan, they can just do your credit evaluation quickly, like within 24 hours. How do you think they're doing that? Where are they getting the information? Credit bureaus. That's where the information is being obtained. Why? Because it will give a true reflection of your credit status as a consumer. And this normally happens in real time. Or sometimes if they want to really dig deep, they can say, no, we'll get back to you after 48 hours or something like that. See. Is it making sense to you guys? Let me show you the flow of documents.
Yes.
So
yes,
and by the way, the whole purpose behind this is so as to ensure or there's appropriate authorization of credit sales. That's the whole purpose behind this, to ensure there's appropriate authorization of credit sales. So what documents would we expect? We'd expect to see the original copy of what? It's copy of the customer order. We understand there's one that is sent to the customer. There's one that goes to the warehouse. There's one copy that is filed in the sales department. We do understand this already. But then there's one that is going to the accounting department so that we can match this against the sales invoice. This one is the one that also goes to the credit department. I'm talking about the last one that goes to the accounting department. It also goes to the credit division. Anyways, credit department is under the accounting department. No wonder then you have your creditors, clerks, and all of that. They are part of the credit department, which falls within account department. Okay, right. So that's it about granting of credit. So they are just there to ensure that, you know, sales, credit sales in particular, they are only offered to customers who are credit worthy, right? Third stage deals with shipping of products. Now, shipping of products is the same thing as delivering, depending, of course, of the type of service you're offering. So if you are into selling physical products, the products may need to be shipped to the customers. If it's a service, you then just have to go and deliver the service to the customers, right? So, but let's look at a case where there's shipment of products now taking place. The most important thing that you need to draw from this is that with shipment of products, definitely the products will be coming from somewhere, especially from our side as the ones that are selling. We need to collect those goods from the warehouse. Now, from the warehouse section, there are certain standardized processes that need to take place, which have to be controlled also, right? And one of them, it has to do with loading of the goods ordered by the customer to the delivery trucks. So there's that movement of inventory that will take place in that process. So the movement of goods from warehouse to the delivery trucks, that whole entire process has to be properly monitored or properly controlled. And so when I'm saying just properly monitored or properly controlled, that implies we need to have some form of what we call physical controls, physical safeguarding of assets. So how do we do so? Some of the ways by which we can actually safeguard, you know, our inventory items, especially from an authorized movement. And unauthorized movement of inventory, guys, it can mean one of the following ways. An authorized movement of inventory happens if inventory is stolen by the employees, right? Meaning say they are taking the goods for their personal use and no accountability is done for it. That's unauthorized movement of inventory. All right, something like that. Or there's extra goods that are loaded to the trucks which were never really ordered by the customer. That's an authorized movement of inventory. Or there's picking of goods from the warehouse and loading them to the trucks without any supporting documentation for it. That's an authorized movement of inventory. So in the warehouse, we would see somebody in the capacity of a supervisor, or what they'll normally call as the warehouse manager. All right. Now, this personnel is there to just ensure that access to the warehouse is restricted only but to authorized personnel, right? And then not only does this person conduct such processes, but we also need to have somebody who's independent, right? Who performs that supervisory function, and normally it's in the form of a security guard, who is there at the entry and exit point to the warehouse section, monitoring what goods are being taken out of the warehouse section and loaded to the trucks, or what goods are being received at the warehouse section from the delivered trucks by the supplier. So the security guard performs such functionalities. Now, what documents do we expect to see, guys, during this process? We expect to see the pre-numbered delivery note, which is prepared by who? The dispatch department. All right. And there are copies that should be generated by the system and they have to be distributed in the following ways. I think there's a diagram for this. It's right over there. So in this process, we still see a copy of a sales order form that was sent. Remember, from the first stage, when the order was received from the customer, there's a copy that was sent to the warehouse. Why is that copy sent to the warehouse? Now that we want to load the goods to the trucks, all right, what do we do when we get that copy at the warehouse? We agree the goods and we prepare the delivery note. So we agree the goods picked from the warehouse against the sales order, and then the same process, what do we then do? We generate a delivery note. Now, after generating that delivery note, notice there's an original and there are several other copies that are made. So all in all, we are saying there's 5 copies of the delivery note that should be generated. And they've got reasons for generating those copies. One is sent to the customer. Why do you think there's a delivery note copy that is sent to the customer? Who should sign it? Okay. Who should sign the delivery note? And it is then sent to them. It also has to go to the account department. And that copy has to come back by the driver, obviously, for it to get to the account department. Or the customer can just email it. But normally with the delivery drivers, they would just ask you to sign for your goods. And then they go back with that copy. They can give you a copy to remain with, but they normally go back with the copy. Why do you think they're taking that copy with? Because it has to be used for record-keeping purposes at the accounts department to update what you're still owing to the company or what you have already settled, okay? Very important. Then there's a copy, guys, another copy that is generated. Excuse me. So there's 2 copies here. Original goes to the customer. There's a copy that is signed by the customer, and then it has to be taken to the accounts department. That is this number 2. Then the third one, it goes to the dispatch area. Why to the dispatch area? Because there's a copy that is used at the dispatch area. The dispatch area is where the trucks would leave the company premises and exit to deliver the goods to the customer. Then there's another copy that is issued to the sales department. Why to the sales department? To alert them that, look, the goods that the customer ordered, we have now delivered them, or we've actually loaded them to the trucks for delivery. That's why this copy is sent to the sales department. Then, of course, like what we would have done in any other department, we need to have a copy maintained to update our records so that we can be able to maintain or keep track of our inventory levels. So we had maybe 20,000 units of inventory at the beginning of the day, Monday. But at the end of the day, we are now seeing that we no longer have 20,000, we are left with like 15,000. So what happened to the 5,000? We have to give accountability for it. So for us to give accountability for it, if we sold that, those inventory items, we need to then see copies of delivery notes so that we can update our inventory levels. We can only do that if there's supporting documentations in place. That's why these copies are maintained. Copies of delivery notes issued for goods delivered to customers. Mind you, a company would not have 1 customer, they could have 20 of them. So there might be 20 delivery notes that are kept as copies to update the company's inventory records for the day. Right. Is it making sense to you guys?
Yeah, it's making sense. Yes.
It really has to give you light. Sorry, guys. I'm catching a flu. Right. So that was in the case where a product was being delivered. So another way of just safeguarding assets there, it's also putting CCTV cameras. I'm talking about in the case where you're dealing with physical goods. So hence you notice under my internal controls, I recommended the use of CCTV cameras should be installed at the dispatch area. Access control to the warehouse should be restricted, with exception only given to authorized personnel only. Deliveries should only be done after proper authorization enforced by the senior manager. The security guard should inspect the goods delivered in the truck before the driver exits the company premises, and the driver should sign the logbook for every delivery made. Right. So it's just pretty much explaining the blueprint. Right. Now, that was in the case where we are shipping physical products to the customer. But what about if we're dealing with a service? Okay. So if it's a service, how do we know that a service was offered to the customer? That's where the use of things like this come into the picture. Job cards. Okay, job cards. Now, when you're talking of services, guys, there's quite a number of services that a company can offer or a business entity can offer. It could be plumbing services, accounting consultations, legal consultations, auditing services as well, servicing of a motor vehicle, beauty therapy sessions, any form of service. So there are different forms of services. Now here, this does not involve any physical product as such, all right? So now, how do we keep track of a service offering to a customer? We can make use of a job card, right? That's where we can be able to record the customer's requests, all right? Like, for example, especially with people that are into construction, my sister is an electrician. So what she does, when she goes to fix something, maybe there was a power failure somewhere, when they go to complete, to do the job, they complete job cards. Why are they job cards used, especially with services, so that we can give account of the service that has been done. So for us to only know that the job was really done, we need to have job card records in place, right? And we can also have other extra verifications with the customer who would confirm that, look, the service was done. Are we together? But normally the documentary evidence is in form of job card, all right? But with some, they are also done in real time, like they'll just complete them on the online platform or online system of the organization after it has been done. So it will be completed online to say we were at the customer premises from this time to that time. So it will just be captured on the. Sometimes there are systems whereby when you go to do a job at a customer premises, you have to indicate the time when you arrived at the customer, they verify it with the customer, and the time when you exited from the customer premises, and they verify it again with the customer. And between that time of entry and the time of leaving the the customer premises, you'll be able to then know how many hours was spent to complete the job, something like that. Some of those things are done with systems which are integrated, but some they can do them using job cards, which can be filled physically. So that is in or timesheets. Sometimes they use timesheets as well. So these are typical documentary records that are used to account for in a case where there's a service, all right? Now, after all of this has been concluded, I'm talking about after the product has been delivered to the customer, or after a service was rendered to a customer, we have to invoice them. In other words, we have to charge them for what we've delivered to them. So we have to charge them. So with invoicing, here's what you see when you get to that stage. You definitely see the customer involvement, obviously. You also see the accounts department, and particularly the accounts receivable clerk, right? And the document they would use, there would still be some supporting documents which were initiated at the ordering stage, or some, especially with shipping or products or rendering of a service, will then begin to see the use of time cards, job cards and all of that, or timesheets, sorry, not time cards, timesheets and the use of job cards. Those are some of the records that will be used in this case to generate the invoice, because you cannot invoice someone for something that was not done, all right? Especially if it's in a case where there's a physical product involvement, right? So obviously in the records, when you invoice, they have to maintain a record for it. So when you invoice a client, you have to debit, especially if it's a credit sale, you have to debit the debtors control and you have to credit sales, which is simple accounting logic. Now, let's get to look into the blueprint so that we can unveil what exactly should be taking place and why do we perform this particular phase of the revenue and receipt cycle. Now, when you invoice the customer and recording of the sale, it's important because we need to have a record, all right, of what the customer acquired from us on credit, how much they have paid, how much is still outstanding. So that particular responsibility is given to what we call the accounts department. So what the accounts department would do, they would match all the documents, notice not some, all the documents received right? And no wonder here I was indicating to you that, okay, the documents used, it will involve the customer order, which we saw from the very beginning. We will also see other supporting documents that we came across over here for as long as they are relevant to the, I mean, to the order of the customer. So you would see all the documents will be matched, which is the copy of the sales order form from the sales department. You also see the delivery note will be matched, which came from the dispatch department, and the signed delivery note, which was returned from the customer. Notice these are the documents that are being matched. Okay. Now, any unmatched documents are immediately followed up. Why? Because then we might be losing revenue. Because you might have delivered goods, but never invoicing those goods to the customer. So guess what's going to happen? You will not recover the payment if you don't follow it up. So very important, following up of any unmatched documents. It's a form of an internal control measure that can be deployed, especially when dealing with credit sales. Right. So obviously, also when you match the documents, all right, the details of the customer should be checked for accuracy. Date of the transactions are very important. Type, quantity of the product sold, the invoice amount, delivery dates should be reflected on the invoice. Very, very important. So it also follows that when the invoices are generated, yes, by the accounts department, there has to be someone that should perform an independent review of accuracy of the details on the invoice before you even issue it to the customer. Why? Imagine you invoice the wrong customer. That will not be good, because that customer would dispute to say, no, I'm not going to pay for something I never bought. So guess what's going to happen? You then fail to retrieve the revenue in that case, unless otherwise you've got the accurate details of the customer that initiated a credit order from you, right? Very important, prices are used on the invoice. Where should they come from? They will be based on the price list of the organization. So under normal circumstances, these things are programmed, especially if it's a computerized environment, they will be automatically populated on the invoice. And like I said, all of these things have to be verified by an independent clerk. And if there's any discounts to be given to the customer, they also have to be taken into account, especially where there's early settlement terms or early settlement agreement with the customer. Now, yes, all of these things have been prepared and all of that, and invoices sent. That's also where things like creditor statements, all right? But in this case, it will be a data statement because you're the one issuing that statement. So that's where data statement is generated and sent to the customer, especially if there is a recurring balance of a customer that has not been paid. So it is done during this stage, guys. So if ever the person was owing us from last month and this month they buy again on credit, but they made a payment, we have to reflect such such payments of that nature where in their data statement, which is normally accompanied with the invoice sent to the customer. Okay. So, and also for reconciliation purposes, you need to have information to use to perform the reconciliation. So obviously to involve the invoices, the data statements, and the other supporting documents that I've already mentioned about. So obviously for record keeping purposes, guess what's going to happen? Once the invoice is issued, it will be used. There's a copy that's maintained internally to be used for record keeping purposes to record the sales in the sales journal, to also record the debtors in the debtors journal. And then, of course, ledgers are also updated for that matter. Now, here's the reconciliation authorized by management, which should be performed regularly, and normally it's done monthly. So notice all those copies. Remember, I told about the copies of the documents. What are they supposed to do with those copies of the sales order, the copy of the delivery note, and the copy of the invoice? They have to be matched, okay? So you cannot have this unless you've matched your supporting documents, right? So you match your supporting documents if they are communicating the same details. That's when you prepare the invoice. And when you prepare the invoice, there's a copy you should maintain for record keeping purposes to record the sales in your accounting records. And then there's an original copy which you give to the customer so that they can be able to also keep track of how much they are owing the company, how much they've paid, and how much they have just recently acquired on credit, if any exists, right? Is it making sense to you guys? Making sense?
Yeah.
Right. The last
Yes.
stage, and we are done for the day. The last stage deals with the receipt of payment. So obviously, you're doing business of revenue in okay, when you're doing business, essentially you're doing it so that you generate revenue. Now, process of generating revenue would also involve you receiving payments for your service, receiving payment for the goods you've sold to the customer. So in this process, guys, it's also under the accounting department or finance department, as you'd call it. But normally we see the involvement of a cash book clerk and the accountant as well, right? So there are certain documents that are used at that stage. One of them would include the remittancy advice, a receipt of payment, if especially it's cash payment, bank statements, especially if it was an EFT payment. Then you also see the debtor statement, the debtor's age analysis being there, and any other relative memos necessary. So maybe it could be that we are making adjustments whereby we issued the wrong goods to the customer. So we need to have a memo indicating that, look, we did a correction to the invoice or to the statement that was initially sent to the debtor. That's the memos that we are referring to there. So anyways, during this process of collecting payments from the debtors, obviously payments can happen in any of the following ways. This one, not commonly used now in these modern days, but EFT, which is normally where bank statements comes into the picture. Cash, it's another way or another form by which payments can be received from the customer, right? So now we need to have proper control over cash payments. And one of the controls when it comes to that is, ensuring that there is proper segregation of duty, especially when it comes to this issue of payment, right? They need to be proper segregation of duty. And also another important thing, an organization should state its preferred method of receiving payment in their policy document. And not only stating it, but communicate it with the customer so that the customer knows which method of payment that the company will be using and whether it's suitable for them. Are we together? So hence I'm saying, yeah, so I've already explained it to you to say the method of payments should be defined in the company policy, communicated to the customer, and they have to reach agreement or consensus when it comes to that. So like I said earlier, the receipt of payment is the responsibility of cash department or a designated cash clerks, where in the accounting department, which is what I've already identified for you, the accounts department, and we see the involvement of a cash book clerk. So they're the ones that deal with this. But like I told you about checks are, especially in the context of questions, barely do you find them mention a lot about checks, because checks are not as used in this modern day age that we are living in, right? So, and of course, customers can also pay via EFT. So if there is an EFT payment, guess what should happen? It should be accompanied with the proof of payment, which is normally emailed to the organization, indicating the reference details as well, right? I think that's pretty much it, guys. Then obviously, this monthly bank reconciliations that should be done. So we call that debtors reconciliation. Yeah, I think that's just much about it. But obviously, all of these things have to happen on a month-to-month basis. And notice whenever we are dealing with payments, we have to ensure that we update our records, in particular the debtor's age analysis, so we can keep track of who is owing us and how long are their debts outstanding. Is it 30 days? Is it 60 days, 90 days or more? So we have to keep up to date with our debtor's age analysis. Why? So that we avoid ourselves from suffering on credit losses, you see. So that is the purpose of a data age analysis, and all of these other documents. They are there for that purpose. So colleagues, that is the summary of a revenue and receipt cycle, and there are risks that can also take place. Like I mentioned, these ones, some of them you see the sense of it, especially when we are looking at a practical question. So I'll try to endeavor to do a practical discussion with you folks on Saturday. Saturday at 5, we'll do a practical discussion on this so that you can see the applicability of the concepts of revenue and receipt cycle. I don't know if there's any questions from you guys concerning what we have discussed on this particular cycle. Questions?
Sorry, can you please repeat on the docs record and receipts of, what is it? Receipts and sales recording. Receipts of payment.
Or under receipts of payment, this one?
Because, yeah, I think I missed out on the data's age analysis.
Or the data's age analysis. Okay, so the data's age analysis, how it works, that particular analysis is used so that we can be able to keep track of what customers are owing us based on time frame. So for instance, if I want to know how much is outstanding from customers, maybe say it is 30 days outstanding, I have to go to the data's age analysis for me to be able to gain a picture of what is owing, what is 30 days owing from the customers, what is 60 days outstanding or owing from the customers, what is 90 days, or what is already above 90 days, meaning to say, if it's above 90 days, then there's a risk of credit losses. So the data's age analysis is used for that particular purpose.
Okay.
Yeah.
Thank you.
You're most
Thank you.
welcome. So it has to be updated monthly. Whenever customers pay, we have to update our data's age analysis, update the data statements, update the system itself of our datas, right? And if there's any adjustments made to the data's accounts, we need to also keep to make sure that we have memos explaining the adjustments that have been done. Maybe say to a data statement because there was an error or there was an omission. That's when memos come into the picture. Make sense?
Okay. Yeah. Makes a lot of sense. Thank you so much. Thank you.
You're most welcome. All right. Any other questions?
Hi, on my side. Hi, can you hear me?
Yes, I can.
I wanted to ask, you said you're gonna send this document on Saturday.
No, today. I'm gonna send you this notes today, but I'm gonna do the practical discussion of I'm gonna send an updated on Saturday, which includes things like purpose of the different respective stages of the cycle. It will almost look like let me see if time allows. Okay. Because I'm left with a minute before the recording. But I'll send you these ones, but I'll also give you the updated ones on Saturday.
Thank you so much.
Yeah.
Thank you.
Welcome, guys. See you on Saturday. Thank you so much, guys, for your time.
Thank you.
Bye-bye.
All right.
Bye.